Well, hi everyone, we're here again for another Fund Manager interview. I'm very glad today to have Alistair Marsden from Nova here to talk to us about his fund and how the co-foundry works. We'll find out what co-foundry means in a minute. But Alistair, over to you. Do you want to say hello and do a very quick introduction?
Yeah, sure. So, hello everybody. My name is Alistair Marsden. I'm CMO of a group of companies called Nova, and I'm a director of Nova Growth Capital, which is the investment arm of the group.
Brilliant. So there we go. Introduction to Nova done with. So let's start off and ask you a few questions about how the fund works and operates, because I know you work on this co-foundry model. Do you want to explain what that means and kind of how that operates?
Yeah, sure. So Nova, the concept of Nova was actually born out about 12 years ago, and it was to try and directly affect or influence the reasons for failure in startups. And the reason we went down that was founders had their fair share of experience of success, but also failure. If you go out there and look at the stats, if you Google startup failure rates, you'll get a number back, usually something like 90% of startups fail within the first 3 years. 3 years is an important time frame, as beyond 3 years, a company is probably going from the point where they're struggling, they're finding out how to make something repeatable, scalable, and profitable. Beyond 3 years, they probably have clients and are starting actually to figure out their business model so they become scalable, repeatable, and profitable. So before 3 years, an arbitrary timeline, startup after 3 years, it's kind of graduating out of the school of startup. And 90% is the amount of companies that fail within the first 3 years if you're looking at high tech, high growth startups. So we thought, rather than building a crystal ball and trying to pick what the 10% might be and use traditional kind of VC maths, we thought if we could shift the dial on the 90%, we might have a greater return. So we went ahead and did that. And the idea was to directly address the top reasons for startup failure. And we do that in two ways, through what we call this co-foundry model. So the first way is we have a repeatable methodology and process that founders go through and address the common reasons for failure, which are around management and selecting problems that are worth solving and not creating solutions to problems that don't exist. And then the rest is actually about the human side. So when you make an investment within VC world, you're generally picking the market, the sector, whether the tech or the business has got some kind of secret sauce, whether it's scalable, repeatable, and it's got a potential to grow. And then there's one which is team. And when that's generally the one that trumps everything else. If the team is rubbish, everything else doesn't really matter. You need to make sure you have a good team. And when you look at the reasons for failure, generally kind of like the majority of the reasons for failure has got some kind of issue around team, whether that's you hiring too early, having found a conflict, or other variations around that. That is one of the biggest reasons for failure. And if anybody who's watching this has had a company that they've started and they've been in, they've probably had found a conflict, and it might have been when somebody exited or the company failed or decisions weren't made. So we went around solving that problem by having our own team of founder types. So we have over 100 people on our payroll, which act as founders within the companies that we start with, founders from out in the open market. They provide more than 500 man days of resource within the first 9 months to try and get people through this really risky period where there is a lot of risk and a lot of failure. And they form this kind of co-founding team. So when you throw the two together, we have a co-foundry model in that we're co-founding businesses on scale, and therefore it's like a foundry, an industrial process. And again, it's just all about addressing the reasons for failure.
Sure. And you mentioned kind of 3 years. Is it? I guess that's the kind of the danger time. Is it? That's the valley of death in that sense. Is that right?
Yeah, exactly. I mean, it's a bit of an arbitrary figure, because if you look at, say, a medtech product, the medtech products, you know, they're going to take more than 3 years to get to a point, generally more than 3 years, where they've got some serious traction, as they might be going through clinical trials, and that alone might take more than a year. But if you're looking at a B2C product, that you hopefully get there much quicker than in 3 years. But in a general rule, if you're kind of trying to put a yardstick down, then it's a 3 year marker. And that again, if all the research that is out there is generally works around this 3-year figure, so we adopted 3 years as this valley of death. Like once you get beyond that, the whole metrics and risk profile of your company changes from being a startup to being hopefully like in growth stage or scale stage.
Yeah, and of course 3 years fits quite nicely with EIS, because that's obviously the year that the amount of time that you need to be invested in EIS to qualify for the scheme. So I see how it all comes together. You mentioned a couple of times within there also the words repeatable and scalable quite a few times. Do you want to give us your kind of definition of what those two words mean in a Nova point of view?
Yeah, so if we're talking about it from, I guess there's two sides. So I mentioned those words probably in relation to a company, but also in relationship to our co-foundry model. So within our co-foundry model, it is a repeatable and scalable model. We see more than 3,000 startups a year. We start generally 20 a year. The year coming, so tax year 21-22, we'll be starting hopefully more than 30 startups. And what we do to make that bit repeatable and scalable is we have generally a fixed 9-month deal with everything that we start and we back. And that's where we provide the 500 man days. And that gives us the best chance of figuring out if something is worth going on into an EIS follow-on round and starting to raise some proper cash. So that in its sense, it's a scalable and repeatable business model as we can kind of forecast out really quite easily how many companies we can start within a given year based on the amount of funds that we can raise in the preceding year. In terms of startups, scalable and repeatable, are kind of going in hand in some ways, in that when you're actually looking at a startup, and one of the interesting things about the startup space is a startup is essentially a group of people which are trying to create something that a market wants, a market needs, and a market demands. And you get on to the point of looking at what a business model could be that is potentially repeatable and scalable. But essentially a startup at the very first instance isn't really worried about scalability and repeatability. Actually, what you're looking for is the opposite for that usually. And therefore, when you look at things like COVID coming along, the companies that we invest in aren't at a place where they have a business model which is scalable and repeatable. They're still figuring out every single deal on a case-by-case basis until they have something that does work. They then stick on that thing that works and try to repeat it. If they can repeat it, they then look for efficiencies so that they can start scaling it. I think when everybody gets a little bit nervous about these investments is when they think, well, there is a scalable model and it is being repeated and they have fixed costs and fixed overheads and fixed process and fixed methodology. And then as soon as you kind of like face a strong headwind, that business model which is being invested in gets challenged. When you're actually looking at the super early startups space, which is where SEIS fits, and early stage EIS, that whole issue and problem doesn't really exist because they're such small, agile, and lean companies that they're just trying to find out how to make a deal, how to create a product that somebody wants to buy, and that's what they're focusing on. They're not focusing on this scalable, repeatable process yet.
Sure. Okay. And I think you mentioned at the start there you've been going for 12 years. So simple maths tells me that on your 3-year model there, you've been doing this kind of in a cycle sense 4 times. So how's it been going? Kind of what achievements have you made in that time? Has it been a successful model in terms of the co-foundry model?
Yeah, so we believe it is. Obviously, over the past 12 years, we've been ramping up. At the start, we're only doing like a few startups a year. The past few years, we've been hitting somewhere between 10 and 20. We've actually started now over 80 companies. Our failure rate, we like to talk about failure rather than necessarily success, as you know, companies are going to fail, and that's why we have the SEIS and EIS tax wrapper. I think the whole sector needs to talk about failure much more. If you take that arbitrary, well, not the arbitrary, if you take the figure that's out there of 90% of startups fail within the first 3 years, our failure rate is at 34%. So if you flip that on its head, the successful number is 10%, which is the market norm. Our success rate to make it beyond 3 years at the minute, averaged out over the past 11 years, is 66%. And What that then does, if you look at the valuations of portfolios, and the way we do valuations is we never increase the value of a company beyond doing a round. So the only time that there's a valuation increase is when there's actually a round and the market sets the price. We do write stuff down, and we write stuff down within 3 years if there is no round, if there is no increase in the value and it is being written off. So our 66% success rate has led to a 36.5% growth year on year for 11 years in our value of our portfolio. So you take those two numbers, it seems to be working. We've definitely got the data to suggest it does. And that's largely why we set up Nova Growth Capital 2 years ago to fix the final area of failure, which is when startups, they chase cash, they chase investment more than they chase customers. So as the co-founding model, we take that on. Traditionally, we were working with other EIS funds out there and syndicating deals on behalf of our startups. But a couple of years ago, we set up Nova Growth Capital and the Nova Co-Foundry SEIS fund to directly invest in everything that the co-foundry starts and bring that source of capital closer to the startups and provide a better continuity of capital for everything that we start.
Okay, so Nova Growth Capital is kind of the birth child of the co-foundry model, bringing that through to its natural conclusion, which is having a fund rather than just doing the deals on a deal by deal basis with a syndicated provider. Is that right? So the fund came in 2 years ago, and now you have, I guess, kind of master of your own destiny in that sense.
Yes, indeed. And I mean, the fund largely, well, wholly invests in everything that the co-founder starts. So that's where the SCIS deal flow comes from. It's off market. This isn't deal flow that is out there that other people are competing for. We are starting these companies. We are first on the cap table. We're quite often actually incorporating the companies, which is why if anybody looks at them, it looks like they're all started in one building in Liverpool, but they're not. And then beyond that, once they use up their SEIS allowance, we then go to the market and start syndicating at EIS on the larger rounds, which helps gives that fair market valuation.
Sure. Okay. Well, I guess 2 years in, and I guess even before that, are there any kind of stars of the show, any companies that you're particularly proud of or have gone on to have particular success? Just give a kind of flavour of what's come through in that time.
Yeah, so we've had, I guess, like the top thing to talk about is a number of exits. We've had 3 exits, the most recent of which was a 45 times return that happened in the height of COVID. And then going on to like kind of live portfolio deals, we have a number. We're sector agnostic. We are experts in starting startups, getting process and methodology in place, and creating products and de-risking that whole process. When we go out to the market, we look for founders that have got some kind of unfair advantage. They're generally sector experts, maybe a little bit longer in the tooth and have experienced a little bit more and have a black book. We let them guide us. So we're sector agnostic to start with. So when we're looking at the current portfolio, we have stuff from really quite interesting and exciting med tech products. We're hopefully just going to be investing into one which is actually linked to brain surgery, all the way down to a Dungeons and Dragons app. If we look at kind of one of the exciting ones at the minute, we are investors in a company called Hygiene. Their founder, so their person with this unfair advantage, Dr. Cook, he came to us a few years ago as the head of infection control for the Northwest in the NHS, wanting to address the problem of transmittable disease through poor hand hygiene. So we built a product with him, which is addressing that problem head on by giving better data to both the individual and the trust at a trust level, so that they can better manage and incentivize staff to wash their hands better and more often. And that product was developed before COVID came along. COVID comes along, and you can only imagine the kind of impact that COVID has on the demand for that type of company.
Fantastic. That's good to hear some success stories. So sounds like it's going really well. And what's kind of up and coming in the portfolio? Have you got any companies? Obviously, we're heading towards tax year end now. I'm sure you're raising money, ready to deploy. Once that money's been raised, is there any kind of on stocks that you're particularly looking at, or is that top secret at the moment?
Well, no, we've and I'll be more than happy to share this with Isa or anybody that kind of contacts us. But we have our end of year pipeline document, which we can share out. Currently, as it stands at the minute, there are 30 opportunities which we're going to get funds across by the end of this tax year. That will probably change as soon as I say that, that means it's going to be out of date. But at the minute, as at the point of recording this, we have 30 opportunities. We had 20 of those are SEIS opportunities and 10 of those are EIS opportunities. So I think we have 13 or 14 brand new like invest first time rounds for us on some startups, and then some follow on SEIS and follow on EIS. And in terms of exciting stuff, yeah, I say like we've got one which is really kind of out there for us, which is around brain surgery. But we've got some really other interesting ones which have been getting some great traction throughout COVID. So we have one called VidiVet. That basically it's online kind of video medicine for dog and pet owners. So you can get direct kind of immediate within kind of like I think they have a crazy time window where you can go on, you'll have a video consultation about your pet. And again, like over COVID, it's been great. They've got a lot of traction. Hopefully doing a couple of big deals in the next few months, and they're in the portfolio. But I'll be happy to share that document with anybody that would like to see it.
Yeah, sure. No, fantastic. It'd be good to hear what you're coming through. And in terms of that deal flow, I was just thinking while you were talking there, where do you get your deals from? Is it from your own internal sources? Is it kind of third-party sources? Where do you get those fantastic companies coming through from?
Yeah, so like I said, when we go and look for deals, what we're really looking for is people that want to solve problems or have seen a status quo and want to disrupt the status quo. They're probably limited in their ability to do that. And they may be limited for a number of reasons. I mean, the whole venture capital and SEIS and ES world is still difficult to break into. So they might not know how to raise cash. They might also not know how to make a product, or they might not be able to or willing to take the risk by giving up probably quite a successful and highly paid job. What Nova does is it provides the framework, resource and cash to allow that type of individual to address the problems or the status quo that they want to disrupt, by providing that whole framework of resource and cash to allow them to do that. So generally these people don't have companies and they're not looking for investment. They're not necessarily coming through universities and looking for investment. They're just general individuals that are wanting to solve these problems. So the majority of our deal flow comes through our digital marketing channels. We find out where these people drink, not physically. And provide content into those pools to get them thinking about maybe coming to us to try and address that problem. We do also have partnerships, so we do partner with universities, but that's more in a generalist approach. And we have partnered with other corporates and other NHS trusts to, again, not look for the big PhD deep tech type problems, but look for the everyday problems that are generally much wider felt across entire communities. And through that digital channel, we put forward our online deal flow content curated program, which allows people, anybody even on this call, you can go along onto our website, sign up, and go through a 2-month mentoring program where you'll come out from having an idea to actually having something which is investable.
Oh, that's very tangible. That's a useful tool to have, I'd imagine. So
yeah,
it's good to hear. Thank you. So in the rest of the year, you got any plans kind of for obviously we're in April now, heading towards the tax year end. I'm sure that's taking up most of your time, but pushing out into the rest of 2021, any big plans for Nova?
Yeah, we're looking at growing. So we are going to be increasing our deals by 50% next year. That's the target. We'll hopefully match that with the valuation increase in our portfolio. We're also starting to look internationally. So we are, we've done digital cohorts in Southeast Asia. We've done 2 of them now. That looks like it's going well, and therefore we may create more. If we decide to do that, then we're going to be launching a general LP GP fund, which will pay for that offshore stuff. The general businesses will probably still be created in the UK, so they may increase the offerings to our SEIS and EIS offering as we go. We're also looking at getting a regional fund set up, and hopefully at a later date an ECF fund. So the thing that the co-foundry allows us to do is actually have scale way beyond we could possibly dream of if we just had a fund. The EIS fund and SEIS fund is it, like you said, it's the ultimate realization of the co-foundry, and that it helps seed everything that the co-foundry does and has that exclusive deal flow from the co-foundry.
Brilliant. Well, Alistair, thank you very much for giving a few insights into the co-foundry model, how it works, and why it's different from other EIS funds out there. It's been really useful to pick up on that. So thanks very much for joining us today. So yeah, that finishes off for this particular video session. Please do go onto the website and check out all the others that are on there. In the meantime, I want to say thank you very much to Alistair for joining us, and we'll see you next time for the next Fund Manager interview. Thank you.
Thanks, Mark.